The collapse of WorldCom in 2002 stands as one of the most infamous accounting scandals in corporate history, revealing the depths of deception and fraud within the telecommunications giant. WorldCom's fraudulent accounting practices, orchestrated by top executives, resulted in billions of dollars in inflated earnings, misleading financial statements, and eventual bankruptcy. The unraveling of the WorldCom fraud serves as a cautionary tale of corporate greed, lax oversight, and the importance of transparency and accountability in financial reporting. Background of the fraud. WorldCom, led by CEO Bernard Ebbers, embarked on a series of aggressive acquisitions and expansion efforts during the late 1990s and early 2000s, fueled by the dot-com boom and fervor for telecommunications stocks. To sustain its rapid growth and meet Wall Street's earnings expectations, WorldCom engaged in fraudulent accounting practices, including improper capitalization of expenses, inflated revenue recognition, and manipulation of reserves and accruals. Accounting manipulations unveiled. The WorldCom fraud came to light in 2002 when an internal whistleblower, Cynthia Cooper, uncovered irregularities in the company's financial reporting and brought them to the attention of senior management and the board of directors. An internal investigation revealed that WorldCom had improperly booked over $3.8 billion in expenses as capital expenditures, inflating its reported earnings and masking its deteriorating financial condition. The magnitude of the fraud shocked investors, regulators, and the public, leading to criminal investigations, civil lawsuits, and the eventual downfall of the company. Executive complicity and corporate culture. The WorldCom fraud was facilitated by the complicity of top executives, including CEO Bernard Ebbers and CFO Scott Sullivan, who orchestrated and condoned the fraudulent accounting practices to meet earnings targets and inflate the company's stock price. The corporate culture at WorldCom fostered an environment of fear, intimidation, and undue pressure to meet financial targets at any cost, overriding ethical considerations and regulatory compliance. Regulatory failures and oversight gaps. The WorldCom fraud exposed significant failures in regulatory oversight and corporate governance, with auditors, regulators, and analysts failing to detect and prevent the fraudulent activities despite numerous red flags and warning signs. External auditors, including Arthur Andersen, failed to exercise professional skepticism and conduct thorough audits of WorldCom's financial statements, highlighting deficiencies in auditing standards and practices. Fallout and repercussions. The fallout from the WorldCom fraud was profound, with shareholders losing billions of dollars in value, thousands of employees losing their jobs, and pension funds and retirement accounts devastated by the company's collapse. WorldCom filed for bankruptcy protection in July 2002, marking the largest bankruptcy in U.S. history at the time. The scandal also prompted legislative and regulatory reforms, including the Sarbanes-Oxley Act of 2002, aimed at enhancing transparency, accountability, and corporate governance in the wake of corporate scandals. Lessons learned. The WorldCom fraud serves as a sobering reminder of the importance of ethical leadership, robust internal controls, and independent oversight in preventing financial fraud and preserving investor confidence. It underscores the need for auditors, regulators, and corporate boards to exercise diligence, skepticism, and integrity in fulfilling their oversight responsibilities. Moreover, the WorldCom case highlights the critical role of whistleblowers in exposing wrongdoing and holding corporate executives accountable for their actions.